Well, Vunani Property Investment Funds has recorded a 55% drop in headline earnings per linked unit to 4.3 million in its first year since listing. And joining us for a look at the results is Rob Kane, CEO of Vunani Property Investment Fund. Morning, Rob. It's a year since you listed approximately, August 2011. Operating profit up, revenue up 48%, but the drop in earnings.
Well, I think what's important, David, and thanks very much for that, is really distribution. If one's looking at the property listed sector, headlines, earnings per share, those sort of things, we need to report on those, but I don't think those are really material when one invests in a property stock. Far more interesting for people is really your distribution. Did you meet that? And on a pro rata basis, we slightly exceeded our pre-listing statement, which if one pro ratas for the shortened period of the listing, we went on the stock exchange for a full year. And we listed a slightly lower rand value. So if one does that, we should have come in at 58.9%. We came in at 60.97. So we're very happy with that. I think the other thing that people look at is the underlying fundamentals in the business. And if we look at those, each of our key performance indicators has actually improved. So we're very comfortable with our performance.
Well, maybe you can go through a couple of those, but certainly with the listing, they paid R7.05 per linked unit when you listed, and that was up to 8.25. So the market liked that. Talking about those key performance indicators, and I always say with property, the language is slightly different. As you point out at the beginning, yes, there are headline earnings per share, but they're not the relevant measure as they are in other sectors. What are the measures that you've been looking at and the investors interested?
I think the key issues for us in kind of delivering to our institutions is, one is distributions, and two is capital growth. Now, if we add those together for the period, we're up at 25.6%, which I think compares well with the industry. I know since the 30th of June, the listed property stocks have run a good deal more, and I think if we include that, we're up at about 46%. The other key issues really are what's happening in the underlying portfolio. Our existing portfolio performed very well. We had good fair value adjustments, and that applies just out of natural income growth, but also out of some refurbishments that we completed. And what's interesting, we did a bit of analysis on the refurbishments, and for every rand of refurbishment cost, we got 3 rand back in terms of fair value adjustment. Now, I think that's a good return for the institutions. Going forwards, I think the key issues really are going to be things like tenant retention. And our tenant retention for this year was 89%.
Let's drill down into the details, because of course all these fundamentals, from a business perspective that you've highlighted, is very dependent and reliant on the operating environment. And as you've just alluded to, you've got your tenant retention on the one hand to consider, and the vacancies on the other.
That's right.
What kind of operating environment are you dealing with right now?
Well, I think it's quite a tough operating environment. And Alicia, when you interviewed me a year ago, I think you highlighted the fact that should we be coming to the market with an office sector-based portfolio? Well, we actually increased that dominance from 92% to 94%. But our vacancies have stayed pretty much stable at 5.8%. And historically, since 2006, that's the range in which we've operated.
I'm very delighted to hear that you remembered what Lisa asked you a year ago. I can't remember what I asked people last week.
I think CEOs are very selective in that.
That's true. You remember us more than we remember you in that sense, surely. But the refurbishment's interesting. You say it's a key competency. And you've said you get 3 rand back for the 1 rand invested in that. Seems obvious to do that. But you're implying that the others don't do that. So this is something where you've got an edge.
I think it is something that we've done in the portfolio, and quite regularly we take investors around to actually look at our portfolio. And we've got kind of before and after photographs for them so they can see what we've done and why we've done it. And I think that's what makes our portfolio very defensive, is we far more likely to take action before the trouble comes. I think once you've lost a tenant, that's it. Very difficult to replace them in this market where we aim to retain our tenants.
How does that cost implication there filter through to your price negotiations? Because I picked up on your statement, lease renegotiations on some of the shorter tenure contracts have commenced and are progressing well. how much tougher do negotiations become, where you've got the costs on the one hand to contend with, and on the other, this real dilemma that you've got to retain your customers.
Yeah, I think if one looks at our year that's just gone past, it was a really big year for us in terms of renewals. We had 38% of our leases expiring. Now that's material, and we've renewed all those leases. So we're very, very happy with our performance. But I think, Aisha, you can take a short-term view and not spend the money. Our position is rather we spend the money defensively ahead of having to suddenly find yourself a new tenant.
How much of that cost, though, can trickle through, or can you push through to your tenants? Are you finding it difficult?
It depends on the market. At the moment, quite difficult. We had 2 big lease renewals in the period, and we came in on budget, but they were about 5% below where we wanted them to be.
Your tenants, you say you like having government and you like having listed companies. Government used to be regarded as a very good client. In some sectors it's not anymore, like construction, for example, where there's been an issue about paying the bills, and in one case at least a company has gone under partly because of those unpaid bills. Do you have a sort of ratio of unpaid bills where above a certain level there's alarm bells?
I think anything that's unpaid is an alarm bell for us, to be quite honest.
But is government a problem?
Not really, no. I mean, historically we traded with very low arrears. We had a slight take-on problem with some of our acquisitions, and that was not due to government, funnily enough. Well, indirectly, we couldn't get a SARS tax clearance certificate. So that, in a sense, was a problem on our side, and we just really struggled to get that. The minute we got that, our government tenants started paying. So I think it just requires discipline. There's no sort of easy, quick fix. It's just hard work.
Yeah.
But we know that market.
The offices, you say that your average vacancies are actually below the IPD, the Investment Property Data Bank. I think must be, of all the industries, there's this enormous amount of information that they generate. You're below there. What are the prospects here for office vacancies? Because if we're looking at growth, economic growth generally being, modest at 2%, maybe more, and possibly downward revision with all the issues in the mining sector, vacancies going to go up or down, or yours going to go up or down?
We think ours will remain stable. If we look at our 5.8% vacancy, we bought one building that had a large vacancy in it, which we didn't pay for. We paid 0 for the vacancy. If we strip that out, our vacancy is actually at 3.5%. I think that's it's difficult structurally to get your vacancies on an office portfolio lower than that figure. So we're really happy with our figure. To some extent with the analysts, you can't win either way. They'll criticize you for having vacancies. But if you don't have vacancies, they'll say, well, how are you going to experience the upside?
You can't win.
I think our focus has always been on tight management, and that's where we want to be.
When it comes to your strategy, in navigating through this operational environment, very interestingly, you've said that you're avoiding premium AAA grade trophy buildings. Is that pretty much your stance that you're maintaining right now, and for just how long is it paying off?
I think we'll retain that for the foreseeable future. It's not so much a direct strategy, it's just that we can't see value in those properties. One is paying top dollar for those properties, and they're also fully rented. For us, it's far more wiser to buy the adjacent property, which we can get in there and refurbish, which in many cases is at a rental of probably sometimes 60-70% of those trophy buildings. So it's an area we've traded in for many years, and we're very comfortable with that.